So most banks would laugh at this situation. A brand new business, no revenue coming in, and the owner has a bankruptcy. But we were still able to walk away with $5K in business funding from a Divvy/Bill corporate credit card. Now, I used to be a business banker at Wells Fargo, and I used to review credit applications every day. So I know exactly what underwriters look for, and this situation would have easily been a hard to approve situation. But before I get into that, go and check out my high limit funding engine down below. It shows you how to build that perfect credit profile that banks can't resist because a 700 plus score isn't enough. And you'll get resources on how to remove any red flags that might be on your profile like this client had. But here's the thing, this Divvy Bill corporate credit card isn't perfect either. In fact, most business owners don't realize its limitations until they actually get approved. I'll share what you need to know about that later on in the video, so stick around. But real quick, let's cover some basics about this Divvy Bill corporate credit card. With that being the first thing, it is a corporate credit card and not a business credit card, meaning this does not have any personal guarantee at all. It won't report to your personal credit profile, only to your businesses. It actually has no interest attached to it, and they only do a soft pull on your Experian credit profile on the personal side and the business side. This account is based mostly on cash flow as far as the approval goes versus credit score. Now, this card also has no annual fees, it has rewards, and they also have employee cards that you can use. But let's talk about the client that I had in their situation. Now, this client had a brand new business. They were only 3 months in business at the time of application. They had a brand new business bank account, which was only about 2 months old. This business did not have any revenue coming in yet. So there were not a bunch of deposits showing this business has thriving amounts of revenue coming into the account. Not to mention, the actual owner had a bankruptcy on their credit report. Granted, it was about 6 years old. Still, the normal outcome for the situation would have been an easy no for pretty much any bank. Because when it comes to business credit, they are a lot more stringent and rigid as far as what they will allow. And especially corporate credit where there is no personal guarantee attached. So what we did differently was, of course, making sure that her business was structured properly and had good credibility as far as, business address, phone number, email, all of the things that add into business credibility. We made sure to maximize certain areas on her personal credit profile to compensate for the bankruptcy that was on there. One of those things was credit utilization, making sure that it was as low as possible without going too low beyond what the banks like to see, and she was at about 4%. Now, also understanding how Divvy likes to make decisions looking at cash flow and cash in account, which usually is best to have about 20,000 in your account when you're applying for something like this. And of course, even more gives you greater odds of approval and a higher limit. But because she also didn't have a lot of revenue coming in, we made some arrangements to make sure that she had a lot of cash sitting in the account, or at least a good bit compared to what she was able to get. So she had about 6,000 plus in the account, and she also made an additional deposit that day of another 6,000. So it wasn't a full on, like this balance is 12,000 showing up in the account, but that pending deposit did show, which likely also helped with the application. And the result of all this was that she walked away with a 5K credit limit with no personal guarantee and without a hard pull on her credit. So why did Divvy likely approve this application? Well, based on what I know from being a banker myself and helping hundreds of other clients get money for their business from the major banks, her business being set up properly to add credibility to her business being legit, being filed as an LLC, having an EIN number, having a business bank account. All of those things, plus a few others, help with the business looking legitimate. The fact that she had a newer account, but she did not have any negative history in that account, which can affect your approvals, and having a larger amount of money in the bank and showing that she deposited another large amount in there also helped with credibility of some money flowing through this business. And it also shows that Divvy is willing to do, test limits to give a person a chance and see if they're going to do good with this account and then give them increases later. Whereas a lot of other banks that only look at the credit score probably would not have given this result. Now, I told you Divvy did have its own limitations. Now, one is that you must pay this balance off in full by the end of the month at most. That's why it's 0% APR, because you pay off the balance and you're not allowed to carry a balance on this card. Now, another limitation is that limits are usually going to be smaller for brand new businesses if you even are able to get approved. That's because they want to test things out and see how you do with a smaller limit if your business is newer and not fully battle tested. Now, I also mentioned that they do have rewards as well. Now, the limitation here is that while they have rewards, it's a little bit hard to obtain the higher level of reward, so it's kind of limited on what you get. For example, you can see that here that it looks pretty high. You get 7 times on rewards, 2 times on recurring software subscriptions, 5 times on hotels, and 1.5 on everything else, which sounds great. But that's if you pay back weekly. Now, if you pay back monthly, the difference is going to be you get 2 times on restaurants, so 5 times less, 2 times on hotels, 1.5 on recurring software subscriptions, and 1 on everything else. So on some of these areas, it's like these two, the software subscriptions and everything else, it's not too big of a difference, but on restaurants and hotels, it changes more drastically. So basically, the Bill Divvy corporate card is not a long-term solution, especially not if you need anywhere from 50K to 100K or 200K in business funding. Looking at the bigger picture here, Divvy is just a stepping stone or a backup account that you can have on hand if you need to get your foot in the door to get some funding. Let's say if you have some past credit issues or if you have a thin credit profile. Which again, if you go down below and check out my high limit funding engine training, you'll learn how to beef up your personal credit profile so that you can unlock those higher limits of funding, as well as removing some negative marks you might have on your credit. So an account like this is a good, first win to have a backup account, just in case you have some money coming in and you need to cover an expense. You can use the Divvy card if you don't have anything else available to you and pay that off before the bill becomes due. Now, the real funding comes when you're able to stack up approvals from the major banks once you get your credit profile to match the blueprint that the banks love. Now, there's another client that I helped to get over 100K in business funding in 8 days after he had been denied and received lower limits like 3,000 at banks that he even had a relationship with. If you want to see how I helped him, then go ahead and check out this video or check out this video, which YouTube thinks you might like. And I'll see you in the next one.